Welcome to the 7th Annual Conference of the Secret Brethren of Accounting Theorists. My name is Michael Moore, and I will be your host for the evening. Today we have two well-renowned experts in this room. First of all, we have Professor Michael Perino. He is also an author of the famous book, The Hellhound of Wall Street. Welcome, Dr. Perino. Also today we have Dr. Jeff Everett. Today, Mr. Perino will be stating his expert opinion on the Great Depression, an event that still exists as a dark cloud in U.S. history. Then we will have Dr. Everett state his opinion on the current crisis. So, Mr. Perino, in respect to the political economic theory, what do you think is the cause of the Great Depression that this country faced in the early 1930s?
And its securities trading arm had engaged in all sorts of unsavory behavior. It sold worthless bonds to investors without fully disclosing their risks, manipulated its own stock price and the stock prices of other companies, and lavishly compensated its executives as the country plunged into depression.
Enticing answer, Mr. Perino. Thank you. So, Dr. Everett, what do you think is your opinion with reference to the political economic theory about the great crisis that this country just faced a couple of years ago?
Thanks for that answer, Mr. Perino. One of the problems with this current recession was short selling. People were selling commodities that they didn't actually own. Another problem was that the housing bubble burst. There was a housing crash. The market value of these houses went down, and a lot of people had to foreclose on mortgages that they only recently got. And one of the greatest problems that contributed to the prior two things I just mentioned was an internal class struggle between the wealthy bankers and common investors. Executives of companies are often looking for a personal short-term gain, and they do that by exploiting personal stock options. And I mean, inherently within that, you have the risk of things like insider trading and asymmetry of information, and a lot of that goes back to immoral accounting practices.
Well, it's pretty interesting how this theory plays a critical role in both the situations. So according to our expert's opinion, what do you think is the correlation between the two crises?
It's almost impossible not to hear in today's financial problems the echoes of those hearings held more than 75 years ago. I have to say, I started this book a month before Lehman Brothers collapsed. And as I was reading these transcripts from 1933, I was also reading the headlines of today. And it was some sort of historical whiplash or something, because it seemed like the same thing all over again. Most Americans then blamed Wall Street and the banking sector for the ills facing the country. There was populist outrage over excessive executive compensation. The market seemed to be awash in manipulative short selling, favorable deals for the fortunate few, and in dodgy loans that were foisted on unwary investors. Against the backdrop of the then exploding banking crisis, the disclosures were riveting.
Those are very valid points. I'd like to add about class struggles here. Going back to what I was saying about conflict in political economy theory, is that people like Jeff Skilling and Richard Fall Jr. of Lehman Brothers would file for bankruptcy protection and other aid from the federal government, taking the taxpayers' money, the lower class if you will, and using it themselves as if they are the higher class. Another problem here is a moral hazard. These executives didn't face the consequences of their own actions. They could depend on federal governments, and at the end of the day, it wasn't their money they were playing with. It was shareholders' money and the public's money a lot of the times. Again, asymmetrical information was present in both these crises. There were bankers encouraging the purchases of securities they knew would fail, but they could make a profit at that time by encouraging that purchase, so they did. Thank you.
Thank you, Dr. Everett. So my next question is, what do you think was the aftermath of these two situations?
In Roosevelt's first 100 days in office and in the year following, Congress passes, and Roosevelt signs, a flurry of banking and securities legislation. There was the Banking Act of 1933, better known for its co-sponsors, Carter Glass and Henry Stigall. In that first 100 days, Congress passes the first federal securities law, the Securities Act of 1933. And then a year later, the Securities Exchange Act, which was passed, which, among other things, created the SEC.
The apparent political result of the economic crisis has been the passing of two bills, the American Housing Rescue and Foreclosure Prevention Act of 2008 and the Emergency Economic Stabilization Act of 2008. The former being an incentive plan to inject the housing market with incentives for homebuyers, and the latter being the well-known bailout of Wall Street.
Thank you, Dr. Everett. Now, as you all know, in response to the current recession, the U.S. Congress summoned a commission called the Financial Crisis Inquiry Commission, also the FCIC. So we will have our experts' opinion on whether this commission, the FCIC, was as effective as Pecora's commission in the 1930s.
The panel's investigation has generated nowhere near the attention that the Pecora investigation has. And as far as I can tell, it's had no discernible influence whatsoever over the financial reforms that were passed earlier this year.
Actually, Mr. Perino, I beg to differ. Pecora's investigation was not the main reason why the U.S. came out of the Depression. Even though a framework was built for the economic future of the country, the Second World War is what truly brought the U.S. out of that depression. It's what re-stimulated the economy and brought together people in economic activity once again. It's currently too soon to estimate the effects of the FCIS. It's only been 2 years. After all the legislation that Pecora enforced in the 30s, very little, you could say, actually held true after the Second World War. That's why we're in this situation again. So I think we're going to have to see what effect this legislation really has.
Dr. Everett. So there you have it, folks. Today our experts analyzed, interpreted, and critiqued the stock market crash of 1929 and its parallels with the recent financial crisis from a conflict theory perspective. Their perspective, shared by scholars such as Wright Mills, is that structural functionalism and theories related to it fail to tell the whole story, seeing society too much as how it should be rather than how it is. In the words of Wright Mills, I quote, "The men of the higher circles are not representative men. Their position is not a result of moral virtue. Their fabulous success is not firmly connected with meritorious ability. Those who sit in the seats of the high and the mighty are selected and formed by the means of power, the sources of wealth, the mechanics of celebrity which prevail in their society. They are not men selected and formed by a civil service that is linked with the world of knowledge and sensibility. They are not men shaped by nationally responsible parties that debate openly and clearly the issues this nation now so unintelligently confronts. They are not men held in responsible check by a plurality of voluntary associations which connect debating politics with the pinnacles of decision. Commanders of power, unequaled in human history, they have succeeded within the American system of organized irresponsibility." A little long-winded perhaps, but writing this in 1956, one could see Mills as a viable prophet, forecasting the further abuses of the exact same kind that brought the world economy to its knees once again.